In a market where everyone says they made money, the wealth gap can still widen. That is the money illusion investors need to understand before the next AI cycle. Welcome to Dragon Bullion. The first lesson is that return percentage and real wealth are not the same thing. Turning $10,000 into $100,000 can feel dramatic. But if housing, premium goods, services, and productive assets rise at the same time, the investor may not become relatively richer. This matters because broad bull markets often make everyone feel smart. The evidence is portfolio value. The hidden question is purchasing power. The risk is that an investor celebrates nominal gains while the assets that define financial freedom move even faster. The condition for real progress is not only a high return. It is whether the return increases the investor's ability to own scarce assets, keep optional cash, and survive a drawdown. If the answer is no, the return may be a money illusion. In a rising market, cash looks boring. In a major adjustment, cash becomes relative power. The person who avoided a large loss can suddenly buy assets at better prices while the fully invested crowd is forced to wait. This is why the report separates return seeking from survival. Survival is not pessimism. It is the ability to stay in the game when liquidity tightens. The condition is simple. If the investor cannot tolerate the drawdown, the position size is wrong even when the theme is right. The opposite case is also important. Holding too much cash during a structural boom can create its own purchasing power loss. So the lesson is not cash forever. The lesson is cash has optionality when valuation, FX, and liquidity stop confirming each other. The second lesson is that capitalism may become more guided by the visible hand of governments and strategic corporations. When public debt is high, governments cannot solve every problem by direct spending. They may instead support strategic companies, own stakes, create demand, and use those firms as future engines of national wealth. AI, space, semiconductors, robotics, data centers, and payment networks fit that pattern. The evidence investors should watch is not only a press release, it is capital commitment, regulation, procurement, infrastructure build-out, and whether the company becomes part of a national operating system. The risk is narrative without execution. A government can support a theme without creating durable cash flow for every listed stock. The condition is to find companies where policy, demand, and business model reinforce each other. The third lesson is that the next financial infrastructure may be led by corporations as much as by crypto-native networks. Stable value settlement, app-based money, and platform payments can become powerful because users trust the company, the network, and the daily use case. This does not mean Bitcoin and Ethereum disappear. They can still matter inside the current cycle. The deeper question is whether the next layer of adoption comes from enterprise settlement, consumer apps, and regulated platform rails. The investor implication is to watch who controls the user relationship. If the user lives inside a platform, the platform can shape payments, credit, rewards, commerce, and financial data. The risk is regulation, reserve quality, and whether users actually need the new rail. The fourth lesson is that high-income industries can change local asset prices. AI engineers, semiconductor workers, data center specialists, and platform employees may not consume all of their income. Once housing is stable, the marginal income can flow into equities, real estate, and long-duration assets. That creates a location effect. Areas around semiconductor clusters, data centers, software hubs, and high-income manufacturing networks can receive persistent purchasing power support. This is not a simple real estate slogan. It is a link between wages, savings, asset ownership, and geography. The condition is real high, income employment, not only a future story. Watch hiring capex, local infrastructure, and whether workers actually accumulate investable surplus. The risk is overpaying for the region after the narrative is already priced. The practical checklist has 5 parts. First, separate nominal return from purchasing power. Second, keep enough cash to survive the drawdown you cannot predict. Third, follow strategic capital where policy and business model are aligned. Fourth, watch platform-controlled payment rails, but demand regulatory clarity and real user adoption. Fifth, connect high-income industries to local asset demand only when wages, employment, and infrastructure are visible. The final condition is humility. A strong theme can be right while the entry is wrong. A defensive cash position can be right while the long-term asset story is also right. The investor's job is not to pick one slogan. It is to match position size to evidence. One more filter belongs on that checklist. Ask whether the story improves your future choices or merely flatters your current position. If a theme goes up but leaves you unable to buy weakness, rebalance, pay taxes, or handle a shock, then the position has reduced your freedom. Real wealth expands choices. Money illusion narrows choices while making the account balance look impressive. Here's the lesson. Money illusion makes nominal gains feel bigger than they are. Downturns make cash more powerful than it looks. Governments and corporations may guide more of the next growth cycle through strategic equity, infrastructure, and platform networks. For investors, the question is not only what rises. It is who owns the scarce asset, who controls the network, who receives the high income cash flow, and who still has liquidity when prices finally reset.